Ladies and gentlemen, welcome back to our Talking Numbers podcast series. It's my all new Talking Numbers series, Talking Numbers Investment Plus. And it's following the series that we created probably maybe 5-6 weeks ago now. And it was our Talking Numbers Property Plus series. And that was with Jay Anderson from Jay Anderson Property. This series is brought to you by Virtual Financial, making financial advice affordable to all Australians. And I'm here with the CEO and founder of Virtual Financial, Adem Becirevic. Adam, welcome back to our Investment Plus podcast series.
Thanks, Paul. Great to be here. Really enjoying it.
Yeah, it's been good fun, hasn't it? It's to be fair, I think the information that you're sharing in a general sense is just fantastic, because I think there's, one of the comments we've gone through a number of times over the first 4 episodes has been what you don't know, and therefore people sometimes don't make decisions because they're not educated. So the ability to go back and have a listen to everything that you've mentioned in a quick 30 minutes has been outstanding. So thank you for sharing with everybody out there. Now today, it is our episode 5 of our 6-part series, which is fantastic. Before we get into today's topic, which is about investments, and we're going to look at property versus shares versus crypto, probably 3 key areas that everyone would like to be involved in. Maybe if you can do a quick recap on episode 4 for me. So what's the top 3 things to remember from episode 4? And we were talking about?
Yeah, okay, in regards to
superannuation
and the different funds. Well, I think the number 1 thing is obviously to get advice. The number 2 thing would be to, it starts with you, to make an effort, and to know what super balance you have, like know what insurances you have under your super, know what investments you have, and really, what your balance is, where your investments. If you don't know the answers to these sort of questions, you really need to, regroup and say, okay, as we said on the other podcast, take 1 day off a year, and if that day might be tomorrow. You might need to start tomorrow and say, okay, what do I have in super? Let's ring up our industry fund. Let's ring up our retail fund. Let's find out what we've got, what our balance is. Are we on track for retirement? How's it invested? Is it growth? Is it balanced, or is it sitting in cash? What insurances do I have under the super? So you need to know the answers to all these questions. So I think, as we said before, probably only 10% of people do. So why don't you make an effort and become one of those 10%? And you know what? If you're not sure where to start, well, email me, call me, and I'll help you.
Yeah, brilliant, mate. That's a great way to start this episode 5, because those little tips are what's critical to making sure you're a part of the 10% and not a part of the 90%, because we want people to get better in the way that they look at their investments or their superannuation, which is, this is the employer contribution, the retail fund that you may be involved in, or the industry fund that you may be involved in. But ask better questions so you're aware of answers. The information at hand, which is fantastic, because that's when you can seek better advice. All right, mate, let's get into today's topic. Probably one of my favorite again. We always look to chat about certain things, and in the past we've done this as well. I know when we ran a workshop at your Brisbane-based office a few months ago, and we spoke about this in particular, where we had a property person talking about property, we had you talking about shares, and we had a crypto expert talking about crypto. So let's get into that. Let's talk about shares versus crypto, all different asset classes, and then property, shares, crypto, all different asset classes, fair to say. So tell us, why would someone opt to enter into either property or shares?
Well, look, I suppose the first thing is that, besides your family home, your superannuation is your next biggest asset. And people are asking themselves the question, how should I invest my money? The 10% of people that do make an effort is ask themselves, how do I invest my money? Do I invest it in property? Do I invest in shares? And it's a question we get all the time. So my answer to that is, if you want to do direct property, well, obviously we need to look at a self-managed fund. So the first question is, do you have at least $300,000 in super? If you don't, well, let's just work and help you with the retail fund to get you to 300,000. And then once you've got 300,000, then let's help you with the self-managed fund to go and buy that residential property. Shares, some clients love shares, and obviously the share market's done very well over the years. And we use what we call an MDA, a managed discretionary account, which has shares, but also has fixed interest and has other investments in the portfolio as well. So property and shares are definitely the two biggest assets that clients are really talking about. And then obviously crypto is one that, a lot of people these days are talking about crypto and investing in crypto. I just spoke to a client this morning, and he told me he's got about $90,000 in crypto. So it's interesting, the way the world's going, and having the right assets in place is really important.
Yeah, I'd agree. And I think that there's still a lot of, I'll say, unanswered questions about crypto, with certainly the volatility of Bitcoin. And don't get me wrong, look, you hear the stories. A lot of people have made a lot of money, and I'm talking about millions in Bitcoin.
Yep.
But the old scenario of high risk, high reward, I suppose, to a certain degree, and the way that it continues to fluctuate is a really interesting one, isn't it?
No, it certainly is. I mean, like with crypto, look, the hardest thing I find is it's hard to invest in something you don't understand. I don't really understand crypto. I know it's blockchain and this and that, and computer people tell you it's the way of the future, and it possibly could be. But one thing you got to remember with crypto is that it's only an asset based. It doesn't produce any income. So when you invest in a share, say you invest in the Commonwealth Bank, not only do you get the capital growth, but you generally receive a dividend of around 7 or 8% a year as well.
Yes.
So you're getting two sources of income, whereas with a crypto you only get one source.
And that's a great thing about whether it's a share, agree. So you've got capital growth and you've got a dividend payment. So you're getting a cash payment every year. And similar with property, I suppose.
Yeah.
If you buy an investment property for, $350,000, $400,000, so we're not talking ridiculous amounts of money, but you can rent that out. So you've got rental income coming in and you've got the capital growth along the way.
Yeah, exactly.
So let's talk about your view on, and I've heard you talk about this in the past in terms of whether it's diversified or let's put it in the language of, let's call it a balanced portfolio. What's your view on a balanced portfolio in terms of, let's say shares, let's say property, let's throw some crypto in there, or I think in a previous we spoke about an alternative asset. And then we've got superannuation as well. What's your view on that?
Yeah, well, look, obviously to have property, direct property in your fund, you need to have a self-managed fund. However, saying that though, we have an MDA that we have MDA Super through the Shartru and investments which we use, which also has property in the fund.
Right.
We believe it's great to have a good balance of those assets, in your fund. So if you're talking about a self-managed fund, you'd be talking about, clients might buy direct property, but we'll also encourage them to also have an MDA where we kind of diversify that out with some shares and fixed interest and alternative assets. And with crypto, basically, that's really can only be done through a self-managed fund or investing in your own name. And look, we just say to clients, crypto is not something we recommend or advise on. But we're not silly. We do understand. I think it's something like 7 out of 10 people have crypto now. So we're not going to turn a blind eye to it. But what we would recommend is in their portfolio, they would really want to keep it down to 10 to 20% of their portfolio. They don't want to put 100% of their portfolio, because as we saw just recently, the Bitcoin dropped by 50% overnight. So if your portfolio was 100% in Bitcoin, your portfolio would have dropped by half. And when you're saving for retirement, the whole idea is to actually have money in retirement. So we don't want to risk your retirement, because when we're doing retirement planning, we're basing everything around about a 6% return. That includes income and capital, which we know we can achieve because we've done that in the past. And we don't want to have any assets in there that are really going to affect our fund and affect their retirement.
Yeah, brilliant. And look, that's so important. So that last 2 or 3 minutes that, Adam, if you're listening to this as our loyal listeners of Talking Numbers Investment Plus, that last bit is just so important to make sure that you're considering that, and going back to even, Adam, what you said before in terms of taking that time out and working out, whether it's half a day or a day, and working through where you want that as well, to make sure you've got that balance. I think that's really important. Mate, in terms of weighting, let's call it, because there's so many different areas that we can look at, whether property, shares, super, crypto. what sort of weighting would you put as a percentage on each of those to make sure it was balanced?
Oh, look, it just depends really on the client and their profile. So that certainly comes into it. And it depends whether they're buying direct property or whether we're just doing property through our MDA. So through our MDA, typically we'll only have around 30% in property. And then we'll have roughly around 40 to 50% in shares, international Australian, and then the balance would be alternative assets, fixed interest, infrastructure funds, and so forth. So it just depends on the client and the weighting, and depending on where they're investing, whether it's a self-invested fund or whether it's a retail fund, it does make a difference. So if a client does buy a residential property in a self-invested fund, obviously the weighting is going to be pretty high residential property. But what we do try and do is we do try and encourage clients to set up an MDA, and all the future contributions and the future money that goes into the fund heads towards the MDA to balance it out. So we try and get back to that 50-50 kind of property and shares.
Right. Okay. Good. And mate, this is probably the hardest part, I suppose. We tend to get the media always has a lot to answer for, because I suppose they're there to sway our opinions, I suppose. And if we looked at an example of shares, investing into companies on the ASX or in the US on the NASDAQ, if I had an appetite for, let's say, tech, if I said, right, I sort of whether it's Facebook, Instagram, sort of WhatsApp, that's under the Meta now, or Google or Microsoft, or I've just gone blank for a second. What's the big electric car company?
Tesla. Yeah.
So Tesla, with what they're moving into,
Yeah.
Is that something that's easily that you can work within those sort of boundaries? If we said, well, I've got an appetite for tech, that's what I'd like to invest in.
Yeah, we certainly can. So we can design portfolios for our clients towards their weighting and towards the companies that we think are going to do well in the future. So we certainly have a broad kind of investment portfolio that we can actually use for our clients. However, we do suggest to clients leave the investing to us, and we can obviously weight it towards a particular industry or particular shares or NASDAQ, whatever it might be. But we'll certainly do all our homework to ensure that we do a lot of research to make sure that where we're investing the clients' funds is right, and making sure it's balanced appropriately. A lot of cases we do invest our clients under a growth portfolio, because we see our clients investing for 30, 40 years. So we really try and spread that risk, and our portfolios, we like to call them risk-adjusted portfolios, because we do have that safety there of property and fixed interest and so forth.
Yeah, clever. And I think that's just as important, is it? So, and I think that's, again, while I might have that appetite, because that's what I'm seeing in the marketplace, and that's what even my children are talking about, it is important, just as important to come and see you and get that advice, as opposed to tell your advisor to come and talk to your advisor.
Yeah, exactly. Because we're going to take the emotion out of it. So as you're attached, we're going to look at it as a cognitive thing, and making sure that there's basis behind everything we do. I think you mentioned Tesla. I mean, they're making billions of dollars of losses every year. So we certainly steer away from those sort of companies. For us, making a profit and having low debt is really important. So investing wisely. So that's something we go through with our clients.
Yeah, brilliant. And I know, mate, in our just getting into property for a second, and I know in our Property Plus, our Talking Numbers Property Plus podcast series with Jay Anderson, Jay spoke about the importance of research, data, understanding the data. Is that something you also support?
Yeah, definitely. I love what Jay does, and I think research is very important. And what he does with his property side is very important. And we certainly do a lot of research for our clients, in regards to any. But before we invest in any share or any property fund or whatever, we do a lot of research to ensure that it fits all of our concerns. Like, for example, not having high debt, having good income. So we have a lot of metrics that have to be met before our investment manager Andrew Meakin, who will be on our webinar going forward every quarter, we're talking about our MDA.
Yeah, very true. We're going to do the lunch and learn every quarter with Andrew, aren't we? So, but I agree, and I think the key thing in there is to make sure that when you are getting that advice and you're going on independent research, with obviously you use from a shares point of view, or let's say Jay uses from a property point of view, it's actual research, it's data, and the data doesn't lie, as opposed to, and I think you mentioned this in sort of one of our previous episodes, where you get emotionally drained. I live in Ascot. I should buy my investment property in Ascot. Well, is that the best? Is that the best what the data? And the data could show that as an example, but is it showing that? And that's the great thing about using research and data.
That certainly is, and I think it's proven, to drill deep into these companies to ensure, look at their balance sheets and look and see what they've got. Have they got high debt? What assets do they have? How's their management performing? We look at all of that, and just to ensure, at the end of the day, the number one thing in investing is to not lose any money. So we don't want to lose money. And the second thing is we want to try and make some money after, once we know that the investment's safe.
No, it's a good point. It's a good point. So mate, we've covered shares and property. Let's talk a little bit more about crypto. And I know we both don't get it. And I know we've both been we're at a investor event not long ago. And what was the other one that we were looking at? That I don't even remember, the NTIFs or whatever it is.
NFTs.
The NFTs. I can't even say it. So isn't that funny that we may leave NFTs to another series when that is totally in another world for me, and I think my children may understand it before I do still. But getting back to, let's say, the crypto side, what's your take on that, given, or I know you're only providing general advice here, but given that it's probably something that you can't recommend, but people are interested to find out more, what's your take on that?
Yeah, look, I think from my, I suppose, research is it's important to invest where obviously there's no guarantees in crypto, but what you want to do is ensure that if you do invest and make money, you can get the money back out. Now the ASX have some crypto companies that have gone through rigorous procedures to ensure that they're above board and have the right systems in place and procedures. So for my clients, if they're asking for general advice, what would you do? Well, my advice would be to invest in something that's regulated, and investing in maybe a regulated crypto on the ASX would be, there's no guarantee, but at least that it's regulated and the government are watching and doing audits and making sure that if clients do invest, they do get their money back. So I wouldn't be investing in some sort of, where you get some sort of code, and if you lose the code, you lose your money. I mean, I think that's a bit crazy.
Yeah, I agree, because that's happened a lot, hasn't it?
Yeah, so I'd just be investing in a regulated fund. That just makes a lot of sense to me. And obviously, I'm not recommending any regulated funds, but if you go to the ASX, you can have a look. And I think if you're going to do crypto, and let's face it, a lot of people are, do it where it's regulated, and if it does go up, hopefully you've got that ability to get the money back out.
True. So there are regulated funds on the Australian Stock Exchange. Is that what you're saying?
There are
crypto.
Yeah. There are. Yeah.
Okay. Okay. I didn't know that. I didn't know that either. So I agree, because that's where the extra layer of regulations, information, reporting, disclosure, that's where it comes into it, as opposed to something that's just a link and a number, and you don't know where things go. So
crypto's not really regulated, you see. So they can do whatever they like.
Yes.
But if they list on the ASX, there's a number of hoops they've got to jump over. So it makes it a lot more feasible, in my opinion.
No, I'd agree with you as well. I'd agree with you, because that's the bit that, when it's not regulated, like you said, yeah, it depends on whether you want to. I'll say, if you've got some play money, if you want to throw $1,000 into it and have a bit of a play, well, that's very different to a serious type of investment that you want to see good returns on. Because if you're going to have a play, you've got to be, my opinion is, be prepared to lose your play money.
Yeah, I think it's good advice. I mean, I think at the end of the day, like obviously, we both don't recommend or do crypto, but if clients want to invest in it, just do it the safe way, do it through a regulated authority, and just remember, it's not going to pay you income; it's just a capital play. and just keep it down to, just think of, as you said, 10%. If it's in your self-managed fund, don't do any more than 10%. If it's outside super, just be very careful, and don't invest what you can't afford to lose.
That's a great piece of advice, isn't it? Don't invest what you can't afford to lose. And I think in those type of less information, less research, higher risk, that's a great piece of advice to finish up with. So only invest what you're willing to lose. It's a bit of a gamble, really, isn't it? It's a bit like going down to the casino or going to the track and having a bit of a bet on the horses. It's similar, isn't it?
Yeah, look, it's interesting area. I'm following.
It is.
I think NFTs are really interesting. So I find it really interesting. But I wouldn't put a lot of money into it. I think it's high risk. It's like venture capital, that sort of thing. There's potentially higher risks. So you've got to be cautious. And
Yes.
Your core funds need to be in core assets like property, like shares, fixed interest, and so forth.
And to be fair, shares and property, again, it's got the history of growth. It's got the history of returns. And that's probably what you come down to, as opposed to, let's say, crypto. It really doesn't have, there's just not enough history out there at this stage, unless you're obviously going to go to a managed fund listed on the ASX where there's a lot more disclosure there. So great piece of advice there. I think what I'd like to do is, to all of you listening to this, I think we can definitely delve a little bit deeper into NFTs and into crypto a little bit more. And that may be something we look to do in the future in terms of another series. And we might look to bring in some other experts that can provide us with that layer of expertise as well. So, mate, great way to wrap up episode 5 of our Talking Numbers Investment Plus series. Any advice or parting comments before we tell people what our last episode is?
Yeah, thanks, Paul. Look, I think it's just important, with crypto, just be very cautious, and obviously, with property and shares, just getting the right advice is really important.
Yeah, well said, mate. Well said. Now, our next show, or our next episode, should I say, is all about the future, and it's all about planning for it. So this is our episode 5. We're about to go into episode 6. So stay with us. If you've enjoyed our series so far, it's our series 1 of our 6-part series of Talking Numbers Investment Plus. Adam, thanks again for joining me today, mate. It's been exciting to again hear your thoughts, your advice, your knowledge. There's no doubt you've got a lot of that behind you, and that's what people look for. So certainly some of the key things that Adam's gone through, rewind it, listen to it again, go and have a listen to episode 1 through to 4 as well, and see if some of those really resonate with you. And if it does, fantastic. If you wanted more information, jump onto the website, Virtual Financial, Google that and have a look at their 5-minute health check. It's free. Go and do it, because these are the sorts of things, again, in this educational podcast series that we want to give back, because we want to make financial advice affordable for all Australians. And it starts with you, as Adam has always said in this series. So make sure you're doing the hard work to make sure you're a part of the 10% and not a part of the 90% that actually does something about this. Adam, thanks again for joining us. To all of you that have joined us, we hope you've enjoyed it, and we look forward to you joining us again for episode number 6, the last in our series 1. Thanks, Adam.
Thanks, mate.